Diving into an investment thesis on DataVolt AI, or DVLT, arguing that its recent stock drop is a severe market overreaction, a bear trap that ignores a huge new licensing deal, and a raised revenue forecast of $200 million.
Yeah, this is a really sharp piece, very timely, titled Why I'm Watching DataVolt AI After Today's Drop. But, if you're going to anchor the entire argument on a number like $200 million, you have to make absolutely sure that figure is bulletproof.
I agree. That's the core of it. The piece makes a strong case. It notes that management just raised its 2026 revenue guidance from, $50 million all the way up to $200 million?
Which is a massive jump.
A huge jump. And given the current $63 million market cap, the thesis says it's trading at just 0.3x future sales. Huge potential.
Right, but the market clearly isn't buying it yet, which is the opportunity. So I think our first point has to be this. The link between the massive $200 million revenue guidance and the identified after-hours catalyst needs to be explicitly strengthened to robustly support the aggressive valuation target.
I see what you're getting at. Right now, the thesis kind of presents the $200 million forecast and the we'll just excel deal as two separate good things.
Exactly. They just feel like a list of bullish points, not a cause and effect mechanism. And the weakness there is that the argument never really spells out how. How does this, this very technical smart contract deal actually scale to justify quadrupling the guidance? The reader is just sort of left to assume the connection.
And that's a big leap of faith to ask for. That $200 million figure is the crown jewel of the whole thing. If the reader doubts the target for even a second,
they dismiss the entire thesis.
Precisely. So we have to close that credibility gap. The suggestion here is that the piece should clearly frame the Wellgistics deal not just as good news, but as the primary tangible evidence that makes that $200 million number credible.
Okay, but let me play devil's advocate for a second. If we tie the entire $200 million forecast only to this one deal, isn't there a risk we make the thesis feel fragile? I mean, what if that deal hits a snag?
That's a fair counterpoint, but for a high-conviction piece like this, you need maximum coherence. You're arguing the market misunderstood this specific news. This deal is the tangible proof we have right now that explains the guidance hike. You have to assume they're connected. Okay, I'm sold. It needs to be more explicit. So how do we actually do that? How do we make that connection feel, deeply researched and not just speculation?
We need concrete examples. So, for instance, you could explicitly connect the nature of the licensing deal, DataVolt's tech going into a supply chain with over 6,500 pharmacies, to the kind of scalable software model that can hit $200 million. It's IP, not a service contract.
Right, it's about scalability. And building on that, the notes mention the size of the addressable market, the $600 billion prescription drug market. We should use that scale as justification for why $200 million is even achievable with this kind of licensing model.
Perfect. And then you reframe the entire narrative. You state that the $63 million market cap is disconnected specifically because the market hasn't understood the scalable revenue mechanism yet. Your thesis then becomes the missing link. That gives you real alpha.
That's a perfect transition to our second point, which is all about the flow of the argument. In an urgent piece like this, structure is everything. As it stands, the script first debunks the panic drop.
Which was just tax selling. Right.
Exactly. Then it reveals the hidden catalyst, the Wellgistics deal, and only at the very end does it calculate the $200 million forecast and the 0.3x valuation.
Yeah, and that's a very standard chronological flow. But standard flows don't create urgency. To maximize the emotional and financial urgency of the argument, the structure should immediately connect the magnitude of the valuation disconnect to the market-ignoring alpha news.
I completely agree. That $200 million disconnect, that's the whole so what. It's why the reader should care right now.
But it's buried at the end.
Exactly. The weakness is that by putting the ultimate financial absurdity after the bombshell news, you dilute the punch. You're making the reader wait way too long for the payout.
You are. And if they wait, the Wellgistics deal just seems like nice news. We need them to understand it's market-defining news. The absurdity of the current price has to come first, and then the deal arrives as the solution.
So if we lead with that huge number, aren't we risking the reader just thinking it's hype before we've actually laid out the proof?
I think it's all about framing. You establish the tension first, then you immediately release it with the evidence. So the suggestion is to resequence things, right after you debunk the panic selling.
Okay, so the whole sequence shifts. You establish the massive opportunity right at the top. After you prove the CEO insider sales were just for taxes, the fake sell-off, you pivot.
Right there, you pivot hard. You say something like, the market just dropped this $63 million company that management forecast to hit $200 million in sales. You frame the panic as a gift, creating this unbelievable valuation.
That creates immediate tension. It forces the reader to ask, how is that possible? And then the Wellgistics deal becomes the answer to that question.
Exactly. You could even rename that section to something that highlights its function, like the catalyst that justifies the $200 million target.
I like that.
And this new structure, it perfectly reinforces the central bear trap thesis. The market panics on bad data, then the real news hits after the close. The structure and the thesis become one and the same.
Okay, let's turn to the third piece, which is always tricky, integrating the technicals with the fundamentals. The material makes a good case here, noting the stock found a hard floor at about $2.05.
And that it saw aggressive buying down there. The data is solid, but the way it's presented could be so much more powerful. The technical analysis should be reframed to conceptually support the fundamental bear trap narrative, rather than appearing as a discrete trading instruction set.
I agree. The weakness is that it's very transactional right now. Entry prices, exit prices, it feels separate from the really powerful story about the licensing deal and the guidance.
It does. And we're missing a chance to use that price action as actual evidence. Evidence that smart, informed buyers were already seeing the undervaluation before the Wellgistics news even became public.
Oh, I really like that framing. The technical action becomes proof that the bear trap already existed. It validates the entire fundamental argument about market inefficiency.
Precisely. So for concrete examples, when you're discussing that bounce from the $2 level, don't just call it a support level. Frame it as empirical evidence. Evidence that smart money stepped in to reject the algorithms that were just dumping shares on misunderstood news.
You're essentially describing a battle on the charts between panicking algos and investors who understood the real value. The $2 floor becomes the front line of conviction, not just a line on a chart.
That is the tone you want. And you can talk about the stock's failure to break below $2 as more validation. It proves that the true valuation floor was already recognized by informed money, which makes the drop look even more like an irrational overreaction.
And what about the upside targets, the $3 plus levels?
You have to tie them back. That $3 target isn't just arbitrary. It represents the market starting to price in the Wellgistics news. It's the first step on the journey out of that absurd sub-0.3x valuation, you see? The technicals and the fundamentals start telling the exact same story.
Okay, time to synthesize. Let's wrap this up for the listener. We basically covered 3 major ways to strengthen this thesis on DataVault AI and turn it from a list of dead points into a really cohesive, powerful narrative.
First, and this is the most critical part, you have to explicitly strengthen that link between the Wellgistics deal and that huge $200 million revenue number. Make the deal the roadmap to the forecast.
Second, you need to restructure the flow. Maximize that impact by hitting the reader with the crazy valuation disconnect right after you debunk the fake sell-off. That creates all the urgency you need.
And third, integrate those technicals. Don't just list them as trading tips. Use the price action as psychological confirmation of the bear trap narrative itself. Show that smart money was already on the case.
So by resequencing the argument and connecting that financial evidence more tightly, especially making that $200 million figure feel completely earned by the new deal, this thesis will become so much more robust and impactful. We really encourage you to implement these suggestions and submit your improved work for a follow-up critique.